Hi, good afternoon, and welcome to our conference call for the quarter ending December. I do hope that many of you are also coming for our analyst day tomorrow, but we still felt that we should continue with the conference call, for addressing routine financial queries, as well as, potentially for any other queries and for the benefit of some of those who will not be able to make it tomorrow. So, it's been a decent quarter. Our sales continued to be at the clip of 575 to 600 crores. We made an operating cash flow positive again, and a slight cash flow positive even over post the capexes. From an overall sales standpoint in NCR and in some of the other geographies, we are clearly seeing a slightly stronger bounce back. I'd still not call it like a huge recovery, but clearly a slightly stronger bounce back, especially for sale of completed inventories. In fact, if you look at all the third-party data also that's coming, it's beginning to show a decline in the unsold complete inventory data across the country, which is good. From a macro standpoint, obviously the interim budget had two very good guidelines for the real estate sector. One was for the consumer, where the second home ownership and the second home renting both became more tax-friendly. And then this entire thing of the notional rent on unsold inventory, which could have hit some of our projects in 1920, has gotten deferred by one more year now. There is this entire ministerial committee on the GST rate rationalization, so that obviously we'll see what it comes out with. But hopefully it should lead to a reduction in the GST rates as well. And while the HFC crisis has not necessarily hit us, it's clearly possibly impacted some of the mid-range players, and let's see how that plays out. For the 9-month cycle, we have done a sale of almost 1,800 crores, which hopefully should put us on the path to exceed our modest guidance of 2250. I don't think there's a concern out there. And obviously our net debt continues at that 7,200 crores number, and we have sufficient liquidity, for the next few quarters of mandatory payments, which in any case would be further bolstered by the capital actions that are also imminent across the next few quarters. So frankly, with the only other two pieces that I'd like to mention about is as some of you would recall, we had taken a big land parcel opposite Cyber City under auction from the Haryana government, from HSIDC, for 1495 crores about, I think, in the earlier part of last year. We have signed a non-binding term sheet with Heinz for a JV partnership there, and hopefully in the next few days, the final documents should get concluded, and the funding should happen, within this quarter. And the last issue was, of course, that I think we have more or less agreed on a large chunk of the assets that will be transferred between DLF and DLF Cyber City, as a significant settlement of the outstanding receivables. Frankly, the financials are hopefully self-explanatory. This time we have tried to, slightly tweak with the way we make presentations to help it hopefully become slightly more user-friendly, and we'll be happy to take questions now.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Hi, sir. Thanks for a reasonably detailed presentation. So just 3 questions. One is on your cash flow slide on slide 14. So 2 things there. One is your collections seem to be slightly lower quarter over quarter. So I was wondering if pre-sales are stable and you're anyway handing over those apartments, why should the collection run rate come down? And secondly is the finance cost which has gone up. Is that just explainable due to just the interest rate hikes some of these banks would have taken during the quarter, or is there something else? And there is this land charge refund of 111 crore. Is that Coca paid divestment?
Yeah. So all the 3. So the first point, Saurabh, was that, it does not reflect any, I guess it's not a reflection on the sales. In the previous quarter, we had the final payments of, I think, 5 separate blocks of Horizon Center 2, each of which, was like a 40-odd crores. So I think we had about 180 crores of Horizon Center collections, because in Horizon Center, as you might know, The minimum size is 15,000 square feet. So now we still have about 80,000 square feet unsold, but most of it got sold in the last quarter. So that was like a one-time blip last time. You are right on the land charges, that actually the land charges continue to be more or less on the same line as last quarter, but there was, I think, a 250 crores receipt on account of Coca Pit. In fact, I would like to guide the audience on the call that actually beat Horizon last time, Coca Pit this time, something else. Every quarter there could be 150, 175 crores sort of, a big ticket entry on account of either a big ticket sale or which either gets booked in the sales line or in the recoveries line. And hence I think, that's otherwise a normal capex in land charges broadly continuing that 125 odd crores a quarter. Your third question was on the finance cost. So there are two pieces to it. I'll be very transparent. One is, of course, the fact that, as you might have seen, we have built some additional cash buffer, honestly for no other reason except that, it's an unfortunate point to say, but given the circumstances in the last quarter, I think clearly one wants to ensure that in the event any of the lenders tomorrow is in a situation where they are unable to, step in for a sudden requirement of funds, you have the cash cushion with you. And the second point is there was a slight increase in interest rates. Our assessment is the DEFCO interest rates increased by about between 25 to 50 basis points, obviously on the new lendings, but even the older ones did go up by about 25 basis points. And C, I think, is that I think there was a final agreement of balances between DLF and Cyber City of the outstanding loans as of September 30th, including the accrued interest thereof. And so that became the new principle on which the interest has been accrued. So I think those are the 3 points which might have led to the increase in finance costs. On finance costs, obviously, I think it's important to reiterate that as far as the third-party finance cost is concerned, and I will not speculate on the quantum, but with the QIP of 17 crore shares, as well as the promoter infusion of 2250 crores, a significant amount of the principal would stand paid out, say, definitely by end of June, which will lead to a very significant drop there. And also as a very large chunk of the 9,000 crores settlement with Cyber City gets settled through asset transfers, we expect that this entire finance cost net line, hopefully by the end of June, should be a very different number than what it is right now.
Okay, thank you, sir. And just one follow-up on slide 19. So your rest of Gurgaon, you have a 3,600 crore odd inventory lying there. I'm guessing this is mostly completed. And against that, if you look at your new Gurgaon sales, that's like 35 crores in this quarter. I think even the year-to-date number is not that great. So I was wondering, is there anything you have to kind of increase the sales? What are your views on that inventory?
So good point. So the 3650 crores includes the 1.3 odd million square feet of Ultima, for which the final OC has not been received, and hence we have not released it for sale. So that will be approximately 1,000 crores, Saurabh. Okay. About 1,000 crores of it is our historical inventory of the plots that we have in phases 1, 2, 3, and 4. So that's also there. But yes, the point is valid that while we have started seeing traction in the rest of India, we still haven't seen the traction required in the ROG portfolio. That basic point is well taken, and I think clearly that would be a focus. We are reinforcing the sales engine there as well, and we hope that as we relaunch the Ultima in the next 1 or 2 quarters, maybe that becomes the pivot to sort of re-energize that sector, exactly as Crest had done on the golf course road.
Thank you, sir. I'll come back for follow-up later. Thank you.
Thank you. The next question is from the line of Kunal Lakhan from Axis Capital. Please go ahead.
Hi, thank you for taking my question. Sir, quickly on the intercompany payables. So this 4,000 crores of enterprise value were transferred to DCCDL. How much of rentals are we talking about?
Okay, so this has not been transferred. I think we are very close to to completing the in-principle agreement with GIC, and the entire documentation and due diligences, will take a few weeks to conclude. We expect that eventually this should be about a 350 crores of rental on a full year basis.
Okay, that would imply...
Actually, if you look at 18-19, the rental will be more like 275 to 280 crores. But if you look at a full year, the full throttle full year basis, it will be at 350 crores, maybe from the fiscal year 2021 onwards.
2021 onwards. Okay, that's helpful. But again, the 4,000 crore is enterprise value, right? So what will be the equity value? There will be some debt against these assets?
So the debt against that is a part of the 7,200 crores net debt that DLF has. So honestly, that we will structure out a method that we are able to, ideally unlock the complete inventory value of it. But that's something that we are doing. So, the way I look at it, frankly, Kunal, is that if I transfer it only at equity value with the existing debt, then okay, the Cyber City payables get reduced by 1,500 crores less, but my net debt drops from 7,200 by 1,500 crores. So the overall payables will clearly come down by this number. The exact mechanics of how much debt is transferred and how much of it is settled before transfer are mechanics that frankly we are working with the banks, with GIC, and hopefully should get a resolution on it very soon.
Sure, that's helpful. And on the same point, the land parcels of 1,350 crores worth, what is the timeline of these of development of these land parcels? Say DCCDL, whenever they plan it.
So one of them is contiguous. It's licensed and is contiguous to the entire Mall of India Gurgaon development. So hopefully, so it's a part of the entire, so Mall of India Gurgaon is like 32 acres, this is an additional 3 odd acres. So that will be contiguous to that. So the Mall of India Gurgaon planning is going on currently, and as it sort of hits the execution stage, hopefully in the next year or so, this will be a part of that. The second land parcel is a bigger land parcel with hopefully 5 odd million square feet development potential, in Chennai. And that, I think, again, is something that we are currently, discussing some regulatory clearances that we need for that. Again, something which, once everything is done, could be launched by the later part of next fiscal.
Okay, great. And one last one from my side. The overheads in this quarter were slightly on the higher side versus the last quarter. Anything peculiar that happened this quarter?
The only thing peculiar, and I'm not sure whether that sort of is the right answer, but I think the only thing peculiar is that typically in the October to December quarter, we pay the annual variable incentives to the entire staff right from the top management downwards. And though we've always tried to argue with our auditors that this should be prorated across the 4 quarters, but they typically, do it on a cash basis. So the entire thing hits you when paid. So this is paid around Diwali. So typically October-December quarter is where that entire spiking takes. So that's the primary reason. I'm sure there might be a 4-5 crore entry here and there for something else also, which I'm not sure. But basically that, I think, is the basic driver.
Sure. Thanks so much and all the best.
Thank you. The next question is from the line of Abhishek Bhandari from Macquarie Securities. Please go ahead.
Hi, sir. Thank you for the detailed presentation and, congrats on seeing the sales pick up again. Sir, I had 3 questions. I'll ask them one by one. The first one is on a slide number 32. If I look at the other income, what TCCDL is booking, which is basically the interest being accrued on the loans outstanding from DLF side, when I will look at it, it's 300 crore for this quarter, which effectively implies the interest being charged by them is 14%. Is that right?
No, the interest being charged by them is 11.5%.
So, sir, then 300, on 8,700 crore or, at 11%, roughly the annual interest cost would be around 1,000 odd, so 250. So, what's the difference between this 250 and 300, what is being shown in that P&L?
So 2 pieces. Cyber City also has certain cash balances which are kept in FDs and all, so they also get those interests. And then I think I don't know, there might be 25 crore entry elsewhere. Naveen, do you have some break about this?
Also, we received 15 crore from account of DCCDL in this quarter.
Okay, so basically this could be in a couple of cases, like if from one particular tenant we received 5 odd crores of delayed interest payment because they hadn't been up to speed on their rentals last year. Similarly, there were some minor disposals. So I think it's a combo of those things, but you're right. The bulk of it is the interest recoverable from DLF.
Okay, so the related question to this is that till we settle out this 8,700 crore from DLF side, the interest will keep getting accrued. So is it fair to assume that this 8,700 crore could go up till the time it is settled, which is September 19 as per your presentation?
What we have agreed is that we have, because now we have fixed that number, we don't want to increase it. So effective the October to December quarter onwards, for the next, hopefully it's only a 2-quarter story, we have agreed to settle the interest in cash every quarter.
Every quarter. Okay. Thank you, sir. That's helpful. So my second question is, going to your slide on 22. I think it was asked earlier also. So if you have mentioned that, you have identified certain assets with EV of 4,000 crore. Could you help us understand, because if I look at your slide 24, the main assets which could actually be, funding that kind of money would be mainly the retail assets. So is it fair to assume that the retail assets are more, under consideration for transfer?
Can't do statutory commercial assets.
So the 4,000 crores, you are right, is the 2 retail malls. I think, there's no rocket science to deduce that, frankly. Obviously because there are some regulatory issues that still need to be handled, we haven't named, but you're right. That's what our hope is, that's what the agreement is. In fact, I think in the previous caller, Kunal, I think, or Saurabh, had also asked the question of what is the rental loss to DLF, and that we had said that for this particular year, it's about 275 odd crores, and on a full year 2021, this is about 350 crores, the full rentals of these 2 assets. So even from a cyber city standpoint, because, this point also has been discussed, and I think it's very transparent that you should know, that since cyber city gets about this 900 odd crores of interest income right now from DLF, so from a DLF consolidated standpoint, what happens is we book the 900 crores of expense and book 600 crores of income through the 67% cybersecurity route. But from a cybersecurity standpoint, again, once this entire debt is settled, they'll obviously get this 350 crores plus the additional DIAL assets which are being also transferred as a matter of contract. So I think they'll clearly get about maybe between 400 to 450 crores of additional rental income, plus they'll get the development potential of some assets which hopefully they'll begin working out pretty aggressively to build out. And each of these is obviously on FMV because the counterparty in this case to negotiate the pricing and all, in all fairness, is GIC. So these are all completely arm's length transactions.
The question which comes to mind is, why don't we transfer all the rental assets to the, DCCDL, which is purely a, rental company, and we just focus on the residential? Is there any logic of keeping any commercial or rental asset on our books?
Okay. So if you want, I'm happy to take you asset by asset. So there are 3 assets which are with us because we are the concessionaires to NDMC. And those assets cannot be transferred as per the concessionaire agreement. There is one particular SEZ in Kolkata which again cannot be transferred because SEZ land again cannot be transferred. You can get a co-developer at a development stage but not at a developed stage. MLCP I mentioned about the NDMC. There is one asset which is a rental asset which is integral to our phase 5 development, which will at some stage come up for redevelopment, and hence we are not transferring that. And the only asset really which technically there's no business or regulatory hurdle to transfer, but we are choosing to retain it in DLF is our corporate headquarters at DLF Center, which we believe should stay on in DLF.
Right, sir, right. So my last question is on your slide number 19. Good to see that we have a very high amount of ready inventory. So, is there any thought process in our mind to accelerate our pre-sales, given that typically, customers will be happy to buy something which is ready, and given the way the prices have not moved anywhere for last 3 years, the sales velocity should ideally pick up. So, is there any targeted marketing campaign or, payment plan or something which is being thought about to help us liquidate? Because this is a key part of us going down from 7,500 crore debt to zero over next, 1 year's time.
Okay. So I'll answer the second part first. Actually, the 7,500 crores should go down to a significantly lower number again because I can't speculate on the value of the QIP I am desisting. And, honestly, it will end up becoming, if I may use the phrase, a relatively irrelevant number, debt equity less than 0.1-ish sort of a thing. So, honestly, the inventory liquidation really has a very limited role to play in that piece. Now, to the second point, which I think is a very important question. If you recall, I think in October of last year, when we sort of began the relaunch exercise, we had an unsold inventory of about 15,000 crores. And even frankly, while we had paused sales from May of 18, the couple of quarters even before that had witnessed very limited traction, especially in Crest. What we saw after we relaunched sales was that Camellias to some degree, but Crest specifically after it was completed and handed over, actually has witnessed an excellent clip in sales. And we believe that frankly, each product sort of turns around at its distinct life cycle. What's good for us in the last 2 quarters is the relative improvement we have seen in the resale, in the sales cycle in National Devco. So as an example, in Q4, in Q3, we got a decent amount of sales from Lucknow, from a Tatar in Capital Green. So, clearly some pieces which we had sort of paused for long. We are hoping that ROG at some stage will turn around. Horizon again has reported very healthy sales, almost to the extent that we are now down to just 80,000 square feet of unsold inventory. So while Camellias will continue to be the heavy value anchor, hopefully in the next few quarters, each of these geographies will have their own turnaround story. And we should be able to, so in that sense, we are not retarding our sales. We are also not madly cutting prices to increase the velocity, because we do believe that if it's a part sold product and if you cut prices at the part sold level, I think in some sense you may choose to be very nice to yourself and the cash flow, but you are being very, very, unfair to your existing customers who have bought it at the price at which they were bought at. See also, if you see, in some pockets of New Gurgaon apart, the resale pricing has begun turning around now. So, honestly, I think the price points that which we have are not that, it's not that market plus 20%, resale he'll get the same thing for 30% lesser. So I think those days are gone. So we do believe that hopefully as the differentiation for the complete inventory increases, people will keep on getting attracted to these sales. Some of these parcels will move slower, but some hopefully will move faster as well.
Okay, sir. Thank you, and look forward to meeting you tomorrow.
Yeah, wonderful.
Thank you. The next question is from the line of Amit Goela from Real Enterprises. Please go ahead.
Yeah. Sir, hi. Thank you for the opportunity. Sir, my question has been answered. It was revolving around the interest charges. That has been answered. Thank you so much, sir. Yeah.
Okay, sir.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good evening. Thanks for the opportunity. So just wanted to ask now on our unsold inventory of the 12,300 crores. Apart from this, we also had receivables from what we had sold earlier. So could you just share the number? What is the cash flow expected to come from those sales?
So I think we'll have the exact numbers, which we can share offline, but ballpark of the total sales made till date, we have collectible receivables in excess of 3,000 crores. And we have the residual cost to complete, including some of the community capexes and club infrastructure that needs to prepare, made in the range of about 2,300 odd crores. So I think between 700 to 800 crores is the net surplus of the outstanding receivables, less the pending commitments to conclude, including the, not only on vis-a-vis those projects, but including the allied infrastructure.
Sure. So on just continuing on that, so sir, then logically our collection should see a bump up, right, from the fourth quarter onwards, because you'll be selling at least on that 500-600 crores of inventory, the ready inventory, plus you will have these collections coming in as well, right? So we could go up to 800 to 900 crores run rate from now on.
So actually, if you see, the last quarter collection was 850 crores, in that sense. So you are right that 8 to 900 crores collections is not something which is unimaginable today. Exactly, because now a lot of it is also dependent on the final deliveries to be made and all of those things. So there could be intra-quarter spikes, but broadly you are correct that these numbers should strengthen.
Okay. So my second question is on the DCC deal. So now that we are almost, some of the assets will get operational, the which are under construction, plus we have renegotiation of the rentals. So any guidance you would like to give for FY20, what would be the overall rental income which the DCC portfolio could generate?
So in all fairness, I'll give you the pointers. We will desist from giving a guidance because we haven't internally, found out the guidance. But so there are 3 pointers that I would definitely say. One is that year on year, there is typically about, that 15% escalation every 3 years. So, a part of the inventory does get re-indexed to that piece. B, as you have seen, that there's I don't know, 5 or 6 million. What are the difference in gross and net?
Gross and net is 3 million.
So there's about a 4 odd million of area which comes up for releasing to mark-to-market every year. And as you would see from the mark-to-market chart, there is a difference of about 15 to 20 rupees in the Gurgaon market and maybe about 10 to 12 rupees in the other markets. So that gets added. And the Cyber Park will be handed over, Cyber Park and Chennai, the Balance Star, will be handed over for interiors. And we expect that both of them should come in for rent generation from about September. Cyber Park is 2.6 million square feet with an average rental in the range of about 115 to 120 rupees a square foot.
Okay. So at least 10 to 15% would be something which is easily achievable on a year-on-year basis, something you'd say?
For sure.
Okay, sir. That's from my... Yeah.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you for the opportunity. So I think I missed the statement. How much of area in Gurgaon is coming up for renewal next year and the year after?
Well, give a second. 1.5 million. 10 lakhs, almost a million. In Gurgaon, overall it is 1.5 next year and the year after is 2.7. This is completing that term.
So on an average, so two pieces. The contracted renewals coming up next year are 1.5 million square feet and the year after 2.7 million square feet. But if you see our track record in the last 2 or 3 years, every year there's also a number between 1 to 2 million square feet of tenants who leave mid-contract because they want cheaper options, and those are also released. So our contracted exits are 1.5 and 2.7, but the mark-to-market number would possibly be higher.
So you're saying 1 to 2 over and above the 1.5 to 2.7 could be the number?
If you look at the last 2 years, the difference between our gross leasing and our net leasing is a summation of A, the contracted renewals, and B, the midterm renewals.
Okay. Secondly, in this presentation, the Taramani offices also don't find any mention. What is the status on that now?
Where would they have found mention, boss?
No, so under the project pipeline, where you have now Hyderabad SEZ taking place.
So the Taramani offices is only because the Hyderabad, we believe, is an earlier one that should commence. Taramani also, as I mentioned earlier, should be commencing hopefully in the latter half of the next fiscal. Taramani launch should also, Taramani, the entire planning start and all should also be happening.
Okay, so it was there in the last presentation, so that still remains with you, right?
So Taramani is one of the potential assets that we have listed for potential transfer to Cyber City.
Yeah. Okay. And
it is not here. Yeah.
Sorry?
And hence it was not in the DLF on the DevCo side of the equation.
Yeah, fair enough. But similar was the case with SEZ as well, right? Hyderabad SEZ. That will also be eventually transferred to DL.
But the only difference being that the Hyderabad SEZ, because of the co-development agreement, actually gets transferred through the sale line. So, DLF builds it, DLF spends the money, builds the asset, and then transfers at a certain price to Cyber City. Here, the vacant site could be transferred to Cyber City, and then they will build and construct. Okay.
So that will be the part of some of the other assets which you have listed for sale.
That's part of that entire settlement process, you're right.
Okay. Lastly, in your slide 38, the Mall of India is 7.7 million square feet?
Just to clarify, this is we have 2 sites. One is Mall of India Noida, which is an operational asset. It is 2.2 million square feet, rental earning and fully leased out. Mall of India Gurgaon is a site which will commence development pretty soon. And that size is 7.7 million.
So Mall of India Gurgaon would be a combination of offices and retail spaces. And the current plan from an FSI standpoint is actually higher than this number, but we believe this is the number that may eventually end up getting developed. Given the humongous size of it, this might be developed over 2 phases. But again, those are things still in the planning stage.
Okay. Fair enough. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thank you and good afternoon, everyone. Sir, how are you thinking about monetizing the phase 5 residential next phases?
So that's a good question, Samir. Are you coming tomorrow?
Yes. Can't miss it for anything. Yeah.
Wonderful. So you should clearly ask the question of Mr. Singh as well. But clearly, I think it's obvious that with the crest hitting completion and the camellias also, hitting about whatever 2/3 of the value being sold, that the time has come, frankly, for us to aggressively start thinking of the next phase 5 project. And I think that's something that is, we haven't put in here anything because obviously, we want to put in here only once everything is frozen. But clearly the thinking on that piece has started.
Okay, great. And so the second question is for the inventory in rest of Gurgaon. If I back out Ultima, then how much are the plots that you mentioned?
The plots valued here, I think about 900 crores. So that is about 1750 crores so of the 3650. Broadly about 2000 crores is Ultima and those older plots. But 1650 crores is actually inventory across various plotted built-up colonies, most of them in New Gurgaon, in that sense. New Gurgaon as a township, frankly, has come out pretty well. I think now maybe a couple of thousand families have already shifted to the DLF Garden City, as we call it. Be it NTH, be it Primus, Regal or Sky Court, and the plotted colonies in Garden City. A lot of habitation has begun happening, the infrastructure has begun coming up. The reason why some of this continues to be slightly slow moving, as you know, is because that is the one pocket which has a very high overhang of finished inventory, not only of us, but of all the other developers as well. So I think while in other zones that problem is not there, but here I think clearly there continues to be a slight challenge in terms of resale prices of some of those apartments, still running lower than what the official rates of the suppliers are. We have seen some traction in Sky Court and Regal in the last 2 quarters, but clearly not enough for us to make a sizable dent in this. But you're right, that is like one spot we would definitely like more of action to be seen.
Okay, and so for your Delhi Midtown project, 1.9 million square feet phase 1, when do you expect this to get completed and when do you start the sales?
So the construction has commenced, as you know. The entire FSI and all has been now fully approved. I think the building plans are approved. So we expect that the construction phase should maybe be done in the next 3 to 3.5 years. We are working in terms of what is the most opportune time for launching its sale. I mean, you know that on account of various regulatory issues, including RERA, we aren't very keen on to launch something at a very early stage. But clearly, I think once a certain degree of structural progress takes place, is the time for both the partners to sit and decide on the launch piece. There's something on which both GIC and us are constantly tapping. But clearly, I don't think it's going to be launched in the next 12 to 18 months. But at some stage, you're right, we are thinking of it. Ideally, we would like to sell everything post-OC, as we have made clear. But I think clearly the way to say is that you'd like to sell something once the uncertainty on that project in terms of delivery has gone away. And that's something. But clearly that would be maybe the next residential piece that will be launched from our portfolio would be that.
Okay, great. So one final question. And I don't know, you may choose to answer the way you want to. For the QIP issue, how are you thinking about the timing, considering 2 things? One, the current market conditions, and second, the upcoming elections?
Okay. So, in all fairness, Samir, so you asked also a tough question, then you say you answered the way you want to. I like that. So anyway, I mean, all of us know everything. So we know the way the market is, we know the election pieces. But the fact is that I think clearly we would like to get it done as soon as we realistically can, really. I mean, we know that we need to get it done within a specified time frame. So honestly, we will look at that sort of opportune micro window to be able to, to take it through whenever in the next few months, that micro window appears, honestly.
Okay, great. Good luck. Thanks.
Thank you. The next question is from the line of Ritvik Seth from Lead Finance. Please go ahead.
Hi, good afternoon, sir. So just a couple of questions. When do you expect the cancellation upgradation to start declining? Because we've been seeing 200 to 250 crores quarterly run rate since the last, say, 3-4 quarters. So when do you expect that to at least start declining?
So the cancellation, I think, hopefully we should be at the fag end of it. Okay. Maybe another 1 or 2 quarters of the slow-moving projects. On the upgradation, my honest answer is hopefully never. We would always love to be able to upgrade 150 to 200 crores a quarter, frankly, from somebody moving from Ultima to Crest, somebody moving from Crest to Camellia. We had, I think, almost 15 cases, 20 cases of people who had a Camellia Simplex moving to a Camellia Duplex. People with a Horizon half floor moving to a Horizon full floor. So, cancellations, you are right. I think it just shows that we did not want to carry unwilling passengers on board, and hence, we were very transparent if somebody wanted out. But upgradation is something that we frankly, leave alone trying to decline. We actually, in some sense, actively try to encourage it if we can.
Okay. And is it possible to share the split between the cancellation and the upgrades?
I don't have it upfront, but I'm sure Rajiv and Kuldeep can share with you offline. Okay. I'm sorry, I don't have it right now with me.
No problem. And so just on one of the slides in the balance sheet, on slide 13, what are the other current liabilities pertaining to? We've seen a significant jump from March to December, even September, from 3,000 to around 12,000, 13,000 crores. So what is that pertaining to?
This has been largely on account of
India's 115.
Sorry?
So this is, if you recall, in March 18, we had the entire new accounting standard change, which led to a reversal of revenue of about 14,000 crores.
Okay.
That was on April 1, 2018.
So what happened with that is a downstream accounting action. Is there a lot of money which I had received from the customers, right, because I was no longer recognizing their revenue, suddenly became an advance received from the customers. Okay. So my current liability column, in some sense it's just an accounting-led change, but right, since we are booking those incomes now, this will keep on declining. But that was the one-time flip that happened.
Sure, that sitting in the other current liabilities.
So what had been booked earlier suddenly started sitting in the other current liability.
This change was effected on 1st of April 2018, and hence you see a very large movement from March numbers to December numbers.
Right, got it. Okay. And so last question, sir, our reported inventory in the balance sheet is around 23,000 crores, and we have around 12,000 crores of ready inventory. So is it safe to assume that the balance 11,000 odd crores is for the land that we have historically accumulated?
Yeah. So this again is the mirror image of the current liability question that you asked. So when that happened, all those sales, the money received from the customers came and sat in my other current liability column, and all those sales made, the POC may say 80% POC has been recognized, which suddenly became zero. So that asset went and sat in my inventory. So honestly, so there's nothing to do with land. A large profit is actually both on the other current liabilities and the inventory is actually the contra entry of the AS 115. I'm sure there were some other components also which the accounting team can flesh with, but the single biggest driver, in fact, one of the biggest challenges that we as accounting team, I'm sure not only at DLF but at most of the real estate companies have been handling in the last 2 or 3 years, is that there have been back-to-back 2 significant accounting standard changes, frankly, and, honestly, while I know that some of our peers have chosen to sort of brazenly defy them, but I think most responsible corporates have ensured that they switch the accounting method of post AS 115, and frankly that's what we've done.
Okay. And also to clarify, our ready inventories on our books are valued at cost. They are not valued at the market price.
Okay, sure. Okay, fine. Thank you.
Thank you. The next question is from the line of Abhinav Sinha from CLSA. Please go ahead.
Yeah, hi, thanks for taking my question on the cash flow slide again. So I just had a couple of clarifications. So the construction outflow that you show of 232 crores, does this include the Delhi project?
No, it will not include. So the Delhi project today is anyway not a big amount. But just to recap, these detailed numbers we show will exclude all joint ventures. So it will exclude Cyber City joint venture, it will exclude the Delhi joint venture, tomorrow it will exclude the Heinz joint venture. In fact, I think with the analysts, we separately need to sit down and understand that as a higher and higher proportion of our business is run out of these joint ventures, which are not technically consolidated, what is the best method of capturing both the pluses and the outflows on those businesses to reflect like an overall, the DLF picture. But to your simple answer to that is no.
And similarly, the debt number will also not show that in either DCCDL or DLF right now.
So like in DCCDL today, my revenue, EBITDA and the PBT PAT columns don't show it. Only the final PAT that they have, I take a 67% of that as a single entry consolidation.
But the Delhi project will not show its debt anywhere right now.
The Delhi project will not show any debt right now because Delhi project today does not have any revenue that is recognized. Yeah.
Okay.
What is the debt in the Delhi project? Any idea? Okay, so, but just for the record, the debt there is approximately 150 crores.
Okay, thanks. And so secondly, on the finance cost also just below this, the net finance cost, this does not include the amount paid to or due to DCCDL, right?
No, the cash flow does not, you're right. The cash flow does not because as we mentioned that all the accrued interest up to September, we agreed with GIC and Cyber City became the outstanding principal which has to be settled by asset transfer and effective January 1, we'll settle it in cash.
So from next quarter, we should see those 200 crores sort of additional.
So I think for two to three quarters, you would see that cash outflow. I think we should be overall still okay in the overall cash flow standpoint. But you are right that assuming that this entire outflow will be extinguished latest by September and hopefully substantially before that. But for the interim to 2 to 3 quarters, you could see that.
Right. Thanks for clarifying that. And sir, secondly, the point you mentioned on possibly accelerating sales of the Midtown project. Now, if suppose the GST rates were to fall to 5%, which the government is contemplating, will that help this decision or how do you see that?
Okay. So I did not say that accelerating. All we said is that once we have a higher degree of structural completion, we'll evaluate. Honestly, if I may say so, the 5% GST is a mixed weapon in that sense, because while obviously it's fine, but the fact is that the input construction costs are taxed at 18%. So even for say a luxury project, if your construction costs are running at say 40% of sale value, you are talking of 7.5% input taxes. So if the output is 5%, the 2.5% just adds on to the construction cost. If, as is also being talked about in some of the media reports, the 5% is a part of a composition scheme. That means you pay 5% and you do not claim any input tax credit. It actually means that from a builder and a consumer standpoint, the total GST payable really becomes the 7% that you are paying on the input taxes, for which you will no longer be claiming credit, and the 5% on the output. So honestly, let's just let's just wait for this final GST regime to come, and then let's understand. Today what happens is, I charge a 12% GST. If my input tax credit is 7.5%, 7.5% I claim credit, 4.5% is the net recoverable. So how this regime changes is something. Let's see also whether they continue with this current dispensation of there being no GST chargeable on a post-OC project or not. Honestly, these are all balls in the air right now, frankly.
Right. But so just theoretically, 5% without ITC takes us back to the service tax regime, right? Approximately.
No, it doesn't. You're right. It takes us back to the service tax regime of there being a 7-8% of...
Give or take 1 or 2. Yeah. Give or take 1 or 2%.
You're right.
Yeah. Thanks for answering my question. That's it.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, so just to clarify, currently the payment that you made on HSIDC, that is the debt on that still sits on your book, right?
So the payment that we have made till December end, if there was no direct debt, I think what we had done was that from our own fund, we had transferred 375 crores to this SPV. So that 375 crores is still on our books. So hopefully, post we sign the JV and the JV takes any further debts, those debts, I mean, just to make a disclosure, will no longer be consolidated in our books, but like Cyber City, I think it's a good practice, and I think we should begin with Midtown also next quarter. We can disclose those separately, but those revenues, those construction costs, those government charges, and those debts, all of those would be deconsolidated from a line-by-line consolidation, and we'll just keep on doing this bottom-line consolidation.
So sorry. So currently, of the 1495 crores, how much have you paid?
So currently, we had paid 375 up till December end, which is here, and we have paid one installment of 375 after Jan 1. So 950 is what we have paid. We hope that with the signing up of the JV, our outflow should only reduce between now and March and not increase.
Okay, so your reported debt will be impacted to the extent of 375 as well, right? I mean,
it will depend on the status of the JV consolidation as of March 31st. If all the documents are signed by then, the equity is funded by Heinz, then it will be deconsolidated. If not, then yes. Okay. Right now, by all accounts, it does look pretty certain that this will become a Heinz DLF JV well before that date.
Okay, sure. Secondly, you mentioned that the valuation of the ready inventory, which you claim at 12,300 crore, is at cost, not really at market price. Would there be a substantial difference?
No. So I would like to clarify that.
Yeah.
The 12,300 is at our last sold prices. So this is not at last sold prices.
So it's market price. Yeah.
This is market price. The 23,000 crore accounting inventory number, there the unsold inventory is being carried at cost. I think that was okay.
Okay. And how much would that be if it's possible to know that number?
We'll need some digging, boss. So tomorrow's analyst meet, so maybe by Monday, Rajiv and Puneet can revert back to you on that.
Sure. Great. Thank you so much.
Thank you. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So thanks for the follow-up, sir. Two questions. So one is, of the revenues that we reversed, how much is yet to be recognized? Basically from what you have completed but not yet recognized. I mean, what is the revenue we have?
Give me a sec. These numbers are slightly tentative because I don't have the final numbers right now, Saurabh. So I think the best thing is for us to reconfirm with you offline, but ballpark if you have to take, I'll say of the 13,500 crores that we had reversed, it appears that we have recognized in the last 3 quarters about 3,800. So that means about 9,700 crores is the unrecognized revenue on the amount reversed as of 1/4. But I'm sort of qualifying that since I haven't sort of, gone through these numbers in detail with my controller, by Monday we'll come back to you with the actual accurate number. But ballpark, a number about ballpark 97 to 10,000 is the number that I think is the continuing reversal to be reversed in the following quarters.
No, my question was, what is the revenue order book today? Like you have sold also in the last 3 quarters, right? So
okay. So
based on what you have sold, what you need to recognize today? I mean, that's the simple question.
Okay, so that we will have to come offline.
Okay, I'll take it offline. No way, sir. The second is, sir,
so that we will take it offline because honestly what happens is the revenue, the unrecognized revenue is a mix of what was reversed plus the new sales that have happened in the last 9 months. So we just need some time to segregate the 2 streams, that's all.
And secondly, sir, there is a disclosure of this 16 million square feet land bank in Delhi metropolitan region. So even if you exclude that 7 of GIC, that Midtown development, what will be the 9 in Delhi? This is page 23 of your presentation.
So 2 pieces. So this is as you said, so this includes Chanakyapuri.
Okay.
So I think between Chanakyapuri and Midtown, this is ballpark about 10.5 million square feet. The balance pieces are our lands in Nazafgarh, which currently have not been developed, are not on the development horizon. But, as the government of Delhi keeps on saying that, if at some stage they come with the land pooling policy, that is what, the acreage that we have is worth 4.5 to 5 million square feet on the normal 1.75 FAR.
Okay. And so just one last question on this. Once you transfer out these payables to DCCDL, so DLF at the parent co level stops recognizing about 1,000 crores of interest on the P&L, right?
Absolutely.
and stops recognizing, let's say, call it 300 crores of interest. So at PBT level, there is let's assume there's a 700 crore out of PBT inflation, hopefully, once that thing happens. The question is essentially, since these things are transferred to DCCDL, does a complete contra entry happen at DCCDL's end, as in there is the interest cost at DCCDL goes up and the rental,
Yeah. So you are right that theoretically, if DLF stops recognizing 1,000 crores of interest and say 300 crores of rental income, so DLF's PBT goes down by 700 crores.
Goes up, yeah.
The PBT goes up by 700 crores. By a flip side, Cyber City's PBT goes down by 700 crores. Say their PAT goes down by 500 crores, and hence DLF's PAT goes down by 2/3. So basically what will happen is that the net benefit from a P&L standpoint of this will essentially be 1/3 of this number.
Okay, so DCCL will not be capitalizing interest on these under construction properties, basically.
No, I'm sure under construction some of it will be, so I'm just taking a complete transparent one-to-one. Obviously, some of those accounting nuances will come into play, that some of the interest on the new build-outs and all will be capitalized there. So hopefully the P&L charge there would be less than what it was on the DLF side. But I'm just saying that if it was a one-to-one transfer, then essentially 1/3 is the DLF benefit. What benefits slightly more, this is just a visual benefit, is that because all the benefits flow into the DLF column, and so the DLF numbers look better, and the delta is on that share of associates line. But that's just a pure visual thing, and no substance.
All right. Thank you, sir.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to Mr. Ashok Tyagi for his closing comments. Over to you, sir.
Okay. So, thank you once again for an extremely enlightening and a very interesting call. Hopefully, as you mentioned, we answered, some of your questions. Some of your questions especially pertain to detailed accounting issues. By Monday, Rajiv and Puneet and Kuldeep, will get offline with you to ensure. And I think, we are hopefully at an interesting phase in our journey when we believe that except for the final leg of QIP, I think we have done most of the hard work. And now I think we should be sort of, cushioned for a happier journey ahead. And we look forward to, frankly, all of you, or at least most of you, joining us tomorrow. And, we promise you an extremely engaging couple of days here. And look forward to seeing all of you tomorrow. Thank you.
Thank you very much, sir. Ladies and